thanks so much for joining. In one of the last videos, we covered income statements, we covered balance sheet, and now I would like to give you an introduction to cash flow statements. Cash flow statements a bit different because there are two different methods, the direct method and the indirect method. I'll make another video to explain you how to convert one to the other, but this video will focus on the introduction, what cash flow statements is, what the key components are, so that you get an understanding why we are interested in understanding cash flow statements. In general, as you know, we covered balance sheet. Balance sheet shows the financial position of an entity at a point in time, reporting the balances of permanent or stock accounts, showing the entity's assets and how those assets are financed. Income statement, we talked about as well, provides an information about a company's financial performance between balance sheet dates. When we look at cash flow statements, reports the change in an entity's cash equivalents, and cash between balance sheet dates. In general, we talk about cash flow from operating activities, cash flow from financing activities, and cash flow from investing activities. Really important because cash flow statement reports performance over a period of time. It is also a flow statement like the income statement. So balance sheet, point in time, income statement, and cash flow statement looks at a period of time. Okay. Let's get started. So what do we have? We have CFO, cash flow from operations. That's the cash that is generated or used by a company's core business operations. Cash generated or used core business operations. This shows the cash inflow and outflow related to delivering goods or service. It mainly covers cash received from customers and cash paid to suppliers, employees, and then also paid as interest and taxes. Yeah. Second one is cash flow from investing activities. That is cash generated or used by a company's investing activities. Cash again generated or used by investing activities, as the name suggests. It covers proceeds from the sale of property, equipment, or investments. Proceeds, sale of property, equipment, or investments. And it also covers purchases of property, equipment, or investments. Yeah. And the last one is cash from financing activities, which is cash generated or used by financing activities related to a company's capital structure. Yeah, again, as the name suggests, financing activities. And here, this basically tracks cash flows between the company and its investors or creditors. And it's mainly, when you look at the inflow side, proceeds from issuing shares, proceeds from issuing shares, bonds, loans, or as a cash outflow, repayment of loans, dividends paid, or share buybacks. Yeah, so we always have those 3 sections. Let's get started on the indirect method. Indirect methods has a following approach. It always starts with net income from income statement. Then it adds back non-cash items such as depreciation and amortization from income statement. It also does additional non-cash adjustments. For example, if you have a loss on sale of equipment. Because what you need to do, you need to translate your net income, which is an accrual accounting item, into a kind of cash accounting item. And then what you do, you plus minus, depending on the amount, cash received from customers, and this is change in accounts receivables, and then plus minus cash paid to suppliers, and this is change in inventory and change in accounts payable. And as you can see, this is normally our net working capital section. Yeah, and D&A, and then basically equals your CFO. Yeah. Direct method. It's a bit different. We don't start with net income. We don't need to do anything on the depreciation. We just look at cash coming in, cash going out. So it's basically cash received from customers, cash paid to suppliers, and then, as mentioned before, suppliers, employees, interest, taxes. So every single cash outflow from an operating perspective you would add here as well, and so on. Yeah. For CFI and CFF, we don't have an indirect method. Yeah. Here we only look at cash inflows and cash outflows line item by line item. Only for cash flow from operating activities we have different methods. Okay, so if we do an example for the indirect method, CFO, we would have net income 100K, then we do our adjustments, plus depreciation and amortization 20K, plus decrease accounts receivable 10K, minus increase inventory minus 5K, minus decrease accounts payable minus 3K. Then if you add this together, you would have CFO of 122K. If we do the direct method, we would have cash received from customers, we would have cash paid to suppliers, cash paid for operating expenses, employees, etc. Cash paid for interest, cash paid for taxes, and then it could look something like 210 minus, let's use the same format, 72k minus 15k minus 5k minus 10k, and then in the end, if everything is correct, you should have 122k as well. Here, whatever you pay, not from a cash perspective, but from an accrual accounting perspective, those items, transaction with suppliers, transactions with your employees, interest payment and tax payments are basically more or less not on a cash basis, but are included here in your net income. And then you do those adjustments to take out, okay, what was paid in cash and what was paid in credit, and do those adjustments. Whereas here you look at the cash component only. Yeah, good. I think that's good. What I'm going to do, I will make another video on CFI and CFF, give you an example, and I will also post another video to show you how to translate from left to right and right to left, because here these are just more or less different line items, so you can't really see, okay, how would we do the calculation, but just to give you an idea what cash flow statements are, and that there are two different methods for the cash flow from operating activities. Thank you so much for listening. Talk to you later. Bye.